Hello students and welcome to the lecture. So students, as we know that we are covering the financial system, and basically in the financial system we are discussing upon the financial institutions, right? These are the topics we have scheduled for the discussion under this series. Like, we will start with the introduction, then we will see the Department of Financial Services, then the classification of institutions, then the developmental financial institutions, types of financial institutions, NBFC types, and the conclusion. Okay, out of them we have done with the introduction, Department of Financial Services, classification of institution, and the developmental financial institutions. These are the topics we had completed. So now what we are left with, basically we are left with the types of the financial institutions. Okay, NBFC types and the conclusion. These three topics we are left with. So basically in this lecture we are trying, or you can say we will try to finish the financial institutions. Okay. Financial institutions. Because now we do not have much to learn about. Okay. We have to just take an overview. We have to just understand what does the terms and how the things functions. Okay. So let's start. I hope that you have revised the previous lecture in the well enough manner before you have come for this lecture, because so many times I have told you this is for your own benefit. Okay. After taking the introduction, after going through the departmental or the Department of the Financial Services, thereafter taking the classification of the institutions, like on the which basis they got classified, thereafter the developmental financial institutions, we had also seen them. Now this is the time that we have to see in the types of the financial institutions. Okay, like which are the types of the financial institutions. Then we will also see the NBFC types. About NBFCs we had already discussed in the previous lectures, but now we will just see the types, and thereafter of course we will look at the conclusion also. So let's start. Types of the financial institutions. First is the commercial banks. Commercial banks are the financial institutions that provide a range of services to the individuals, businesses, and the governments. They accept deposit from customers and provide loans, mortgages, and other financial products. The primary goal of commercial bank is to earn profits by charging interest on loans and other services provided to the customers. Okay, so basically, if we talk about the commercial banks, let me give you an example. This is the bank. Okay, bank. Okay, here are two parties. One is the depositor, another one is a borrower. All right, depositor submit the amount in the bank provided the loan to the borrower. Okay, that's why we also call it as an intermediaries, right? Okay, so basically if we talk about this, then we know that the depositors are entitled to receive the interest from the bank. We also know that the banks also getting the interest from the borrowers. Okay, and the difference between the given interest and the earned interest is the part of bank's income in the generalized way. Okay, so this is the basic function of the bank, right? And the banks which operate on these basic functions are known as the commercial banks. Okay, because they are providing their services of accepting deposits, granting loans to earn the profit or the income. All right, so basically this is the commercial bank. Primary goal of the commercial bank is to earn profits by charging interest on loan and other services provided to the customers. Okay, apart from this, some banks also provided the insurance facilities. They also provide the different kind of loans, investments and all, but the ultimate aim is to earn the profit. Got it? So keep this thing in your mind. Thereafter, what we have the merchant bank. Merchant banks are the type of financial institutions that specializes in providing financial services to the corporations and the governments. They engage in activities such as lending, borrowing, underwriting, trading securities, and offering advisory services for mergers and acquisition. Merchant banks plays a crucial role in the capital market by facilitating the flow of capital between investors and the businesses. Okay, so basically, if we talk about the merchant bank in the particular way, so the only difference, or you can say the major difference, not only, but the major difference between the commercial banks and the merchant banks is that merchant banks deals with three kind of customers: individuals or households, thereafter corporations and governments, right? They deal with them all, whereas the merchant banks only deal with corporations and governments. Okay, this is the most significant difference between them. All right, the merchant banks are not dealing with the individuals or the households like me and you. They are only deal with the businesses and the governments. Okay, so that is the reason why we call it as a merchant bank, not as a commercial bank. Okay, so whatever they are doing, whether they are lending, they are borrowing, they are underwriting. What do you mean by the underwriting? We will see in the upcoming, or you can say upcoming slides in this lecture. Thereafter, the trading securities, offering advice services for the mergers and the acquisition. All of these kind of things, whatever they are doing, they are basically doing for corporations and governments. Okay, they are not doing this kind of things for individual customers. Got it? Now here we have seen that there is something written down as a merger and the acquisition. So now I'm going to ask you the question, like, what do you mean by the merger? What do you mean by it? And what do you mean by the acquisition? Just tell me. I have already told you about this, so I hope that you know the answer. You have 15 seconds to think and then I will give you the answer. Your time starts now. Just think about it. Merger and acquisition. The time is going to be up soon. 5 seconds left. The time is up. So if we talk about the merger, so when two or more entity combine together and form new one is called merger. All right. Then we talk about the acquisition. When one large entity acquires or by the small entity is called acquisition. All right. So this is the basic difference. For example, suppose this is X, this is Y. Okay. they both getting merged together, they become the XY. Alright, but here this is X, this is the large group, this is Y, this is the small group. Okay, so what happened? The X acquires and you can say buys the Y. Okay, so this is called the merger and the acquisition. Okay, so keep this thing in your mind also. Merchant banks plays a crucial role in the capital market by facilitating the flow of capital between the investors and the businesses. Okay, and how they do it? So basically you can say, if we talk about this is the bank. Okay, here is corporation 1. All right, so corporation 1 having the X amount. Okay, corporation 1 2 is needy of it, right? This is the scenario. So what will happen then? The corporation 2 will give the amount to the bank and then the bank will give it to the corporation 1. All right, so here this one is the investor, this one is the borrower. Okay, in between of this, what we have the intermediary. Got it? That's the thing. All right, so here the intermediary is basically the merchant bank. All right, so that's how they work. Mutual funds. Mutual funds are the investment funds that pool money from the investors to invest in the diversified portfolio of the securities such as stocks, bonds, and other assets. Investors in the mutual funds purchase shares which represent their ownership interest in the fund's asset. Mutual funds are managed by the professional investment managers and the returns earned by the fund are distributed among the investors based on their holdings. So, okay, so you could say, suppose there are A, B, C, D, and E. There are 5 investors. A has invested 75, 25, 50, 60, 25. Okay, or just make it 30. Now, if we add of them, if we add them 100, 150, 210, 240. Total amount is 240. Okay, or for example, you can say that it's that all amount is in the denomination of the lakhs. Okay, so this will be 2 crores 40 lakhs, right? So suppose by this they had bought 10 securities or shares which is worth of rupees 2 crores 40 lakhs. So if we go by the definition, what was that? It's a money pooling. Okay, and that money will be accumulated and using for buying the securities or the shares. Like we could say that these 2 crores and the 40 lakhs is not belong to the single person. It is basically the, you can say, accumulated amount of all the investors which were participating, right? 75, 25, 50, 60, 30. All right, that's why it is known as the mutual funds and you can say money pooling. Okay, and where to invest the money, from where the money is to be you can say expel out, all of these things is basically managed by professional fund manager. Okay, this fund manager will manage the amount. Okay, and whatever the profit will be, he will charge some fees for his services, and the rest will be distributed among themselves as per their shares. For example, if combinedly they have earned the profit of rupees you can say 60 lakhs, for example, through these 10 securities, so this 60 lakhs will be distributed amongst them as per their ratio. A will get the highest, then the D will get, then C will get, then E, and then B. All right, so that's how the mutual funds works. Got it? Thereafter, what we have the mutual saving banks. Mutual saving banks are the financial institutions that were originally established to serve the individuals with the small savings. These banks pool deposit from customers and use the fund to make investments, including bond and blue chip stocks investments. Mutual saving banks operate on the mutual basis, meaning that the depositors are also the owners of the bank. Okay, so here you could see, suppose A, B, C, D, and E. Okay, this is the picture. So 75, 25, 50, 60, and 30. All right, again, all of this is in denomination of lakhs, right? That's what we have seen. So the total amount will be how much? 2 crores and 40 lakhs, right? All right, that will be the picture. So suppose they all opened a bank called the XYZ. Okay, so now this is the mutual bank. Okay, in the previous example we have seen the mutual fund, like all of them come together, invest their money, make a fund, then buy the shares and securities. But here all of them come together, accumulated their amount, made the initial capital, established the bank, and then the bank will work for them, okay, to invest the money in the shares, securities, and all. All right, so in such a scenario, all of these peoples who having the investment in the mutual banks will also considered as the owner of the bank. Okay, so in mutual banks no outsider is allowed. Okay, only those who had invested their money into the capital will be the part of the bank. Unlike the mutual funds, like whosoever wanted to be the part of the mutual fund could give the amount and can join. But in the, you can say, the mutual bank, the joining is some kind of typical. All right, this is a scenario. Third, basically they use the reinvestment of their profit. Reinvestment of profit. So you could say, what do you mean by this? Suppose by purchasing and selling the securities, they have earned the profit of rupees 60 lakhs. Okay, this is their profit. All right, so instead of distributed it amongst the shareholders, or you can say amongst the owners, and you can say the fund holders, like the mutual fund, in which we had seen whatsoever the profit will be distributed amongst the holders. But here they, instead of distributing the profit, they use it as a part, which is known as the reinvestment of the profit. For example, 60 lakhs is the profit. Now they have granted rupees you can say 10 lakh at 5% interest rate. Okay, it means that how much interest they will charging? They are charging rupees 50,000 as an interest rate, right? But on subsidy, they have provided that the 10 lakh rupees will be available at 2.5%. Okay, so it means that now the interest will be only rupees 25,000. Okay, compare these amounts, the difference is total how much? Rupees 25,000. Okay, so the profit will be used to compensate this amount. So you could say that the reinvestment of profit is basically done to provide the loans and the securities to the internal members on the subsidies basis, and to comp off the face value, this earned profit could be utilized. Okay, so that's how the mutual banks works. Thereafter, what we have the investment bank. Investment banks are the financial institutions that specialize in providing financial services related to the securities. These services includes securities underwriting, market making, and the advisory services for mergers, acquisition, and the restructuring. So here we have seen some words like the securities underwriting, okay, market making, advisory services for the mergers, acquisitions, and the restructuring. So let's start with the securities underwriting. Securities underwriting, like what do we mean by this? Okay, so basically securities underwriting is, you can say, comprising mention, terms and conditions, okay, buying price, okay, risk associated, all right, you can say maturity date, all right, reselling price. Okay, so this is called the securities underwriting. Okay, so you could say, suppose if there are 10 securities issued by the seller. Okay, so basically, what are the terms and conditions? What should be the buying price? What is the risk associated with these securities? What will be the maturity date of releasing these securities? What should be the reselling price? If the securities is to be transferred from one owner to the another owner, in the reselling process, that what should be the price? So all of these kind of things are basically done by the investments bank. So that's why they are called as a securities underwriting, and they basically, you can say, break negotiation between seller and buyer, like we had seen in the previous examples, like corporation 2 and the corporation 1. Similar example is fit here. Okay, so this is called the securities underwriting. Thereafter, what we have the market mapping or market making, you can say. All right, so market making is, you can say, controlling buying and selling price of securities based on releasing and holding procedure. Okay, so you could say here basically demand and supply works. Demand and supply works. It is controlling buying and selling price of securities based on the releasing and the holding procedure. Okay, suppose if type 1 securities, okay, this is a type 1 security. It's having the high demand but low supply. What will be the condition? The prices will be high. All right, And suppose if there is a bank called the XYZ, this is the investment bank. This bank wants that the price of this type 1 security must be up to some limit. But due to the high demand and the low supply, the limit has been crossed off by the type 1 security. So what will happen? To balance the situation, they will start releasing the type 1 security into the market so that the supply could meet up the demand. And when this will happen, what will happen? The price will be stabilized. Okay. Similarly, if we take out the next, you can say example. Suppose the demand is low, but the supply is high. So what will happen? The prices will be falls down, right? So XYZ will do holding of the type 1 security. They will hold it so that the supply could reduce, and when the supply will reduce, again it will comes in the equivalence to the demand and the price gets stable. So that's how they make the market. Thereafter, advisory services like the advices for the mergers, for the acquisition, and for the restructuring. Okay. Investment banks play a crucial role in the capital markets by facilitating the issuance and trading of securities and providing financial advice to the corporations and the governments we have just seen. Thereafter, what we have the NBFC types. So basically, if we talk about it, so we know that the NBFCs plays a crucial role in the Indian financial system by providing the variety of financial services. NBFCs are broadly classified into the three types based on their activities and regulatory requirements. Like the first is that accept deposits. NBFCs are allowed to accept deposits from the public under certain conditions and regulations prescribed by the RBI or the Reserve Bank of India. Must comply with the rules related to the minimum investment in liquid assets, maintenance of the reserves, and submission of periodic reports to the RBI. NBFCs that accept public deposits are required to have a minimum net owned fund of rupees 25 lakhs. Okay. So basically, when we were studying about the NBFC, the thing I had told you is that they are only allowed to lend out the price. They are not allowed to accept the deposits, right? But some, you can say, NBFCs are allowed to accept the public deposits, but on the certain conditions. Like first, they must maintain the minimum investment in liquid assets so that whenever they are required to meet their NDTL, if they are accepting the deposit, they could easily do it. Thereafter, maintenance of reserves, okay, and the submission of periodic reports to the RBI, okay, like what is happening to them. All right. Thereafter, if any NBFC wants to accept the public deposits, they are required to have a minimum net owned fund of rupees 25 lakhs. If the NOF is below 25 lakhs, they are not allowed to accept the public deposits. Okay. And basically, they are only allowed to accept the deposits for the time period of minimum 12 months and maximum is 60 months. Okay. So if you convert it into the year, so you can say they are hardly allowed to accept the deposits from 1 year to the 5-year time period. Okay. That do not accept or hold public deposits. NBFCs are not permitted to accept deposits from the public. They raise funds through other means such as issue of bonds, debentures, and loan from banks and the financial institutions. That's what I have already explained you in the previous lectures. They do not accept public deposits and are not subject to the stringent regulations applicable to the deposit-taking NBFCs. Okay. Now we have the core investment companies. CICS are the specific category of NBFCs that primarily invest in shares and securities of their group companies. They are required to invest at least 90% of their total assets in shares, bonds, debentures, or other securities of their group companies. CICS are not allowed to accept public deposits and are subject to the regulatory oversight by the RBI. So here we have found two words. First is core investment company. Okay. Second is what? First is the CIC. Second is group companies. Okay, so here we are required to understand them both. Okay, so basically we talk about CICS, then they are corporations which invest only in group companies involving in many industries but holding by single parent company. Okay, so you could say CIS are the corporate CIC are the corporations invest only in the group companies involving in many industries but holding by single parent company. So let's understand it. Suppose there is a company ABC, X, X, Y, Z, D, E, F. X is in the telecom, Y is in the healthcare, Z is in the education, D is in the tourism, E is in the IT, F is in the sports. But they all are owned by ABC. So if we look at this picture, what we will see that ABC is the parent company, okay, and all of these are basically the holding companies. So this is the picture created over here. All right, parent company holding so many companies, and all companies are involving in the different you can say industries, but they are part of the one group which is held by the ABC. So the CIC is basically funding all of them. All right, it means that the companies involved in the different industries belong to one group holding by one single parent company. Okay, hope CIS concept clear to you. All right, basically they are required to invest at least 90% of their total assets in the shares, bonds, and the debentures or other securities of their group companies, means in these companies. All right, and they are oversight by the RBI, Reserve Bank of India, and not allowed to accept the public deposits and are subjected to the regulatory oversight, which we have seen. Now the conclusion. In conclusion, we could say that financial institutions in India, including the banks, the NBFCs, and the DFI, play a crucial role in the country's economic development by mobilizing saving, providing credit, and facilitating the investments. These institutions serve various sectors of the economy, including agriculture, industry, and the infrastructure, contributing to the overall growth and the stability. The reestablishment of development financial institutions and the regulatory reforms in the financial sector aim to address gaps and support infrastructure development. Moving forward, a well-regulated and diversified financial sector will continue to be essential for India's economic growth and the development. So here we have finished the financial institution. Next lecture we will start with another important series. Till then, just revise all the facts and figures we have discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture. What we say? We say thank you.